Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with Carter Malloy. Hey, Carter.
Hey,
Glad to have you on the show here. It's been too long, trying to get you on for a while now, but glad to have you. So Carter, tell us a little bit about your background.
I grew up here in Arkansas where I currently live in a farming family. And then let's see, did science in school, did a dozen years of investing, both at an investment bank and then at an investment fund. In the background, I've been buying and selling land and farmland specifically, and really loved it. Sort of had this passion. It's in my bones, I guess, and it's a bad addiction. But was having really fascinating financial outcomes, but pretty difficult transaction experiences. And so ultimately visiting with my dad, as I do most days, about the business of farming and land, and tossing around ideas of how we could make this a profession of what we were doing. And at the same time, I had friends that were asking to invest in land as well. So it seemed natural to build an investment platform. And so that's my quick background. More interestingly is the company's background, which is about 4.5 years old at this point, since actually standing it up, 5 plus, everything else considered. Today we're approaching 150 people. We've done well over 100 farms on the site, so hundreds of millions of equity invested through our website. And the underlying principle is very simple. We help connect great farmers that want to grow their operation to folks that want to invest in farmland. So the investors come on our site, and in a matter of a few minutes, an accredited investor can gain exposure in their portfolio to farmland. And likewise, on the other side of that transaction is a farmer that wants to buy some land. And so we partner with that farmer, and the investors will buy the underlying land. And the investors will get a rent from that farmer or revenue share. Plus, they can be exposed to any appreciation in the value of that land.
So tell me, I mean, it sounds like you got started in farmland kind of early. What is it that's most attractive about farmland?
Yeah, emotionally for me, right? It's rural America. It's being outdoors and being involved in agriculture and food production. Financially, there's a litany of reasons, or a long list of reasons to be interested. So historically, the returns have been low double digits, call it 11 to 12%, unlevered, right? So without debt, so without much of the volatility you see in other markets. So while the S&P or real estate or other forms of investment might have similar returns, they also have much greater volatility, right? They can swing around in price in much bigger ways year to year than farmland does in its consistency. Another interesting attribute is that we can't really find any correlation between farmland's financial performance and that of other major asset classes. So said differently, you tend to see lots of asset classes move in lockstep, right? Stock market goes down, a bunch of other things go down as well. Farmland tends to be fairly idiosyncratic and move on its own. So if you look at, as an example, the 08-09 recession, when there were really bad losses in many public markets, farmland continued its slow and steady march up and to the right through those years. And again, that's through two ways that it's performed historically. One is asset appreciation, so the value of the underlying land. And then two is the income that land produces. Or can produce.
So it's interesting. You don't hear much about farmland on Wall Street, and you certainly don't hear much about it from the investor circles. You hear about real estate, you hear about stocks, but farmland is an enormous asset class, yet you don't hear about it. So why is this not more well known?
For a host of reasons. One is it's not located in those places, right? So our company is here in the middle of the country, near a lot of farming land, where this is something we see every day and think about. It is not an asset that's been turned into a real financial product historically. There have been private equity funds playing in the asset class for a long time, since the 80s and 90s or even earlier. And just in the last 10 years, as an example, we've seen private equity exposure in farmland grow from something like 3 or 4 billion to 30 or 40 billion today, plus large individual investors like Bill Gates, which I'm sure you've seen the headlines for. So there is increasing participation, but that has to be put in the context of there's $3 trillion with a T of farmland in the United States. So participation by investors is still very, very small. And we are really excited as a company, one, to see the growing interest, and two, to be able to connect those smaller investors with those smaller farmers.
So I'm curious because I know that farmland's kind of been the redheaded stepchild of Wall Street for like the last 20 years. I remember there was a large institutional research firm in Wall Street that had a farmland analyst and actually just let her go, not because she wasn't good, she's pretty much the only one around and she's phenomenal, but there just doesn't seem to be any interest from institutional investors. So what caused that change recently? Like you said, 10x for the private equity exposure. What's caused that change, and where do you think that's going to go?
One is broad increases in liquidity. So the amount of farmland changing hands every year has continued to grow from 10 or 20 billion to 50 billion, closer to 100 billion. So you're seeing more turnover, more ability to access it as an asset class. Another very large impediment to outside capital has been transparency. So there's just an incredible amount of opacity throughout farmland. It's really taken local or hyper-local knowledge to gain access, plus millions of dollars historically. So those are pretty material barriers, and that's areas where we as a company are really focused to help bring new solutions and bring information and transparency, frankly, to the market to create a more functioning land transaction market.
So I know one thing I've noticed with institutions is when they get involved, they tend to compress the margins, they tend to compress returns. So, have you started to see that? Because the numbers I get thrown at by some people involved in farmland is more like maybe like 6% return a year. So, how's that different from kind of what you're seeing?
So an important consideration there, one is that I talked about that 30 to 40 billion dollars of institutional capital.
Mm-hmm.
Let's say we're way off and it's 60 billion. There's $3 trillion of farmland alone, right? Excluding recreational land, land to make other types of alternative investments into solar, wind, et cetera, remediation. So what that means, 30 billion or 60 billion over 3 trillion means that private equity is maybe 1 or 2% penetrated into farmland. Compare that with most other major commercial real estate, and it's always double digits, and sometimes it's like 80 or 90%, right? So we're incredibly early. So we don't see that as a factor that's materially compressing margins or having any impact. If anything, it's helping some of the small to medium-sized players scale up their own operations, and there's real economies of scale in farming, as you can imagine. Owning equipment and buying seed, you get better deals. So we're seeing again, we're very early in this trend, and we as a company focus is on the smaller end, right? So a fund may focus on looking for the next 50 or $100 million deal. We really focus on that sweet spot of kind of $1 to $10 million, where there's a lot of liquidity, relatively a lot of liquidity and availability for us to really make a difference.
Okay. So what's, I know a lot of farmland is owned by families and generational families, like it doesn't really turn over. So, where are you seeing that turnover? Or actually the other question too is how much is actually owned by families?
The extreme majority of it. So the very large majority of farmland is family owned. More and more, that is not family operated, right? Distinct difference there, where something like 40% of farmland in the US is rented out to a non-owner operator. And that's the segment of the market we participate in, right? So call it $1 trillion of farmland is rented out. And that's you often see more turnover in that type of farmland than you do in the long held owned and operated. Where we really like to play and participate is working with those owner operates who want to expand their operation, right? So if you think about the supply side of our marketplace, and it's just a really material and important differentiator of our business model, is that we're farmer first, is that we find most of what we do through working with local farmers who know that area better than anyone does, and they can come in alongside us and have some skin in the game often and grow their operation, right? Whereas they may not have another $5 million to go, or $5 million at all, right, to go buy a plot of land. We can help come up with that capital and help them grow their business.
So one thing I wanted to ask, because there's different kinds of farmland, right? So what do you see as, what are the different types, and what do you see as kind of the pros and cons of each?
To broadly separate the two, there are row crops and there are permanent crops. So row or annual crops, those are things that you plant every year. The picture behind you is a great example, right? Things where like cotton, corn, soybeans, sorghum, wheat. Every year you're out replanting and then harvesting at the end of season. Those compare for a number of different ways to permanent crops, which are things that are a little more permanent in nature. So things that grow on vines and or most often on trees, sometimes bushes. So think almonds and pistachios or oranges and apples. As a general statement, row crop farming as a landowner tends to be far simpler because there's planting every year and harvesting each year. There's rent that comes from the farmer usually. So a very simple relationship between the two, and sometimes some sharing and ups and downs. That has produced over time around that low double-digit return, with a little more coming from appreciation and a little less coming from yield. That then compares to permanent crops, again, things growing on trees, usually pecans, walnuts, etc., where you as the investor usually own not just the land, but the tree itself, and that tree has real value. So because of that, there's a little more operational exposure. There's a little more variability in income levels from year to year. And there is ultimately what that has proven out over time is similar total returns to row crop land in that low double-digit range, but with more of it coming from income and less of it coming from appreciation of the land.
So you're saying the row crops, it's more, you'd say more from the income, less from the appreciation?
That's permanent crops, more income, less appreciation. But if you to peel it back one layer further, those trees can depreciate in value over time, right? So if your land underneath rising by 6% a year, your trees may also be coming back by a couple points a year, working against that appreciation.
Nice. So it sounds to me like it makes a lot of sense to own the land that you can rent out to farmers and let them take the risk, and you're basically just you're just renting out land to people.
We tend to, on our website, we tend to have a similar mix to how a lot of the industry looks at a portfolio view, which is a little more row crop land than permanent crop land. Then behind that, we're starting to do, we've got a timber team here, including a former PM of $1 billion of timber. And so we've now launched and are quickly growing our offerings within the world of timber.
Yeah, so that brings up other parts, right? Because there's farming, then there's timberland, right, which is technically still farming, and then there's livestock too. So how does livestock? We talked a lot about plantings, but what about livestock? How does that come into play?
We are not there yet on livestock. So for a couple of reasons, we have some real hesitation around that and haven't yet found a great product market fit. We've done loads of research and have had several people spend some real time on this, but we haven't found as exciting of a risk reward paradigm within livestock that we have within the worlds of farming and timberland.
So what are some of the issues with livestock that you don't like as much as plantings?
So far, it's primarily really been there's often little value add on the land, and so the appreciation potential of the land is a little more limited. And then the other is the livestock business in and of itself is a fairly low margin one, and so the rents don't tend to be highly encouraging. That being said, there are some interesting new approaches there. One is intensely value-added livestock, so in the worlds of premium livestock, if you will. The other is then using that pasture land as a carbon sink. We are still not quite. We're very, very excited about the developments in the carbon market and the growth of demand there. The land portion of carbon capture, measurement, and verification is not quite to the level of professionalization that we would like to have it and see it as a business.
So now I've noticed when I'm driving through farming country, I tend to see a lot of windmills and sometimes some solar farms. How does that come into play if you're a landowner and you're renting it out? Does that go to the farmer that you're renting to, or does it go to the landowner?
Usually goes to the landowner. So the landowner can, the Midwest is an example where we see this quite a bit. The landowner can rent out a small portion of the land to a wind turbine company. And trade, obviously, the farmer can reduce the number of acres that they're farming and paying rent on that farm.
Okay. So, as investors, I know most investors I talk to, this is relatively new. So what are some things they should look for when they're looking at farmland? Like, how should they look at this as an investment? How should they go about analyzing it?
The first thing I would suggest is reading and studying, right? Just like it is with any asset class. At our website on AcreTrader.com, there's just loads and loads of information to peruse through. We also encourage people to verify that with third parties, right? Don't view us as the only source of truth. There's plenty of information and research out there. Nuveen, TIAA has put out some great stuff. Prudential has some great stuff out there. So it's really worth digging around. I think then immediately digging into the risks and rewards and understanding what drives the quality of any one offering or any one parcel of land is really important. And to that extent, there are many idiosyncrasies among them. It's important, and I think it's like we can make a proxy of investing in commercial real estate. It's a deal by deal thing, right? You really want to go understand, because one strip mall may be entirely different than an industrial park, or one strip mall may be entirely different than the next retail center. So we encourage people to do research on the industry and then to do intense research on individual offerings. We are firm believers that the best investors and partners for us are educated ones.
Okay. So maybe we can talk a little bit about, the process if somebody's going to look for a farm, how they can go about that process.
Yeah. So I think one important thing, actually, I'll start with something not to do, which is equate your kitchen table to the returns received, right? So an example is 60% of U.S. farmland is corn and soybeans. And, like automatically we think about an ear of corn, you're like, I haven't had that stuff in years. But the extreme majority of these things are feedstocks, right? So whether that's for fuel or more importantly, heading into markets like making oils, making other products, and feeding animals at a very, very significant scale. So, and then not like there are things where just because a food is trendy does not necessarily mean that food is actually a good long-term risk reward. So first is sort of dispelling of that concern of the kitchen table, and then again on our side, reading the materials available on the site to understand the different types of approaches in farmland out there. Speaking with our teams, we've got a whole team of investor education folks whose entire job is not selling, but instead of educating, so providing information to the market and answering questions. So we ask people and are delighted with people engaging with us.
Okay. So what are some of the risks that people should be aware of when they're investing?
Yeah, the first one and the loudest one is investing always includes the risk of loss of principal, or even all of it, right? We don't see that happen very often in farmland. It's hard to make it disappear. But there are real risks in investing, and we certainly ask people to be informed there as well. So there are both macro and micro risks to be considerate of to dig in a little further here. Macro risks, right, are long-term commodity cycles. We've just seen a lifting in commodity prices over the last year or so alongside inflation. That can be a positive for the environment, the land environment in general. But it's something to keep an eye on, is these broader cycles and long-term trends. Then macro risk as well is certainly broader economic risk, has both positive and negative connotations for the value of land. Then there are micro risks that can come alongside any one parcel of land, right? So has there been appropriate underwriting on the water? And in California, that is making sure you have enough of it for a very, very long time. And in Iowa, it's making sure you can get rid of it. There's too much water in important parts of the growing season. So water diligence, soil diligence. So are the underlying soils appropriate for growing a myriad of crops here? And then financial characteristics. Is this priced appropriately? Are there investments being made to improve the value of this property? What's the tenant like, et cetera? Certainly, all of these things are made available on our website and through our team very openly on any one offering. So again, it's deal by deal to dig into those things, but they're very important considerations.
So are you guys choosing the tenants, or is that chosen by the investors?
So the tenants we have pre-worked out as the deals go onto the site, relationships with them, and often because the tenant brings us the farm as well, then they're partners we're familiar with and working with already. So the tenant usually comes along with the farm. We view that quite often as a very big positive.
Okay. So are there any trends in farming that, that are interesting that people should be aware of?
Yeah, I think one is yield improvement has been a positive trend over time, and all signs point to expectations for continued yield improvements. What I mean by that is the amount of food that comes off of 1 square of farmland or 1 acre of farmland. That's a positive generally, and a positive for revenue on that farm. So that's a big one, and really you can double click on that theme and go pretty deep in the worlds of ag tech, of what else. There's really, really cool stuff happening in robotics and AI to genetics to just very simple on-farm implement improvements to drive those things. So that's a pretty fun and fascinating trend. I think we are intrigued by what's going on in some of the world of vertical farming. It's an extremely niche market, right? So if you're growing microgreens next to Chicago in a container, then it can make some sense. But as a broader statement, the biggest expenses of that tend to be water and light, the electricity to put power and light in there. And in our world of what we would call horizontal farming, old school outdoor farming, those two things are free. So cool stuff happening all around us. I think it's all, again, sort of contextual and can be somewhat niche, but we're really excited to see a lot of the innovation that's going on in the world of farming and agriculture and land.
Do you see any risks for the farming business model kind of moving forward?
Risk to the business model, no. I think like we will always need people, right? Computers are not going to buy and sell farms, and computers are not going to farm, right? They can help you drive tractors, and they have been for a really long time. But ultimately, the business itself of growing food, I believe, is one of the more sustainable ones in the world, for the simple reason of we all have to eat, right? At the end of the day, that's one of the overly simplistic but lovely things about owning farmland is that there is demand for this product. Right? I don't know what's going to happen to Bitcoin tomorrow or next month or year, but I do know that the people that are alive are going to eat.
Yeah, no, that's a good way to look at it. So what are some of the best parts of the country for farming? I know the U.S. is kind of one of those countries where we've got a lot of farming, and we were kind of, I don't say unique, but we've definitely got an advantage globally. But what parts of the country are better than others?
We're here in the middle, so we've got, like, in our bones are the Arkansas Delta, sorry, the Mississippi Delta. So here in Arkansas, Louisiana, Mississippi, Tennessee, Missouri. Then moving up north into the I-states and the Midwest, really, and the Corn Belt, pretty phenomenal soils there as well. So that's a lot of the core of what we do. But then we have done a lot in the Southeast, as an example. We find Georgia to be a really fascinating place. And then all over the West Coast. So the Pacific Northwest, really fascinating. Idaho, Washington, Oregon, also California. There are water risks throughout California, then there are water opportunities throughout California. And that I'll give you an example, almonds. So about 80% of the global supply of almonds comes from that one singular state, from California. And there are water issues, there are known water issues there. So if you are on a farm that has bad water, you may eventually cut down those trees if you don't have enough water to sustain them. Inversely, if you're on a farm with good water and growing almonds, there's supply coming offline because the other people are taking them out, then you can actually be in a really good position as if almond prices come up because of that reduction in supply. So there are some really exciting areas of opportunity within California on the West Coast. And then we've done a number of offerings in Australia as well. I think we're pretty excited about the market there as well.
Nice. So you guys do international as well?
We do.
So you mentioned water a few times, and I know that's kind of a known risk certainly with farming, but I think in general on the West Coast, there's a lot of issues with water. So how do you see all that playing out? Because I've seen, a lot of, let's say, California policies come out and saying, well, you got to restrict your water usage, but that never applies to farms. And of course, farmers use most of the water that's being used. So how do you see all that playing out if that becomes an increasing problem, no matter what the climate is? No water's no water.
So I think that this one it can do is for the water insecure farms that are growing high value crops, the cost of water will go up, right? So the good news there is there are a lot of low value crop farms out there as well. Rice or alfalfa is an example. So growing things to feed animals there with alfalfa. That is a pretty water intensive crop, but it is lower value than growing tree nuts as an example. So what I believe you could see is what we call fallowing of acres. So the farmer that's growing alfalfa is saying, hey, you know what, I could make just as good of a net profit margin selling my water to my neighbor as I could growing. So I'll sell my water to my neighbor. Now for that pistachio grower or whoever it may be, it can drive up their costs. Again, however, if you are one of those farms with great water and really good long-term access, you're very well positioned relatively to those that are water challenged. So there are, and like to your point a moment ago, right? California continues to restrict for residential, but not for farms. Part of the reason there is because the farming industry produces a crazy amount of GDP or of revenue within that state, and it's a hugely impactful, positive thing. So we hear things like, "Oh yeah, they're not going to be farming in California in 10 years." But I don't know how to. I bet against that statement. But like 80% of our vegetables and fruits come from there. You bet they will be farming in California in 10 years.
Okay, good. Well, that's helpful background knowledge. All right. Well, as we kind of wrap it up here, any kind of final thoughts or things you think we've kind of omitted? Do you think are relevant for the topic?
I think we've hit a lot of great themes around the interest in farmland broadly from a micro and macro perspective, our platform and what our aims are, and how to make it easy for people to gain exposure here. And then I haven't spoken much about or bragged much about, but it's always fun to brag about the people I work with. So mentioned it's growing towards 150 folks at this point. Half of that roughly is software engineers and data scientists and folks in that realm, and then half are operational. So lots of farming and farming family type of people around here, all with a shared underlying common goal. And so we are really excited to continue bringing opportunities here and matching up investors and capital with high quality offerings in the world of land.
That's great. Well, I think you underline an important element of farming, which is people. So appreciate that nod. All right. Well, Carter, where can people find more about you?
AcreTrader.com. They can find more about our business and our people and our impact as well.
Okay, awesome. Well, Carter, really appreciate you coming on the show and sharing your wisdom with us. Definitely, listeners who are interested in farmland, check out AcreTrader. And we'll probably have you back on the show in the future. I don't think this trend is going away, and I think if anything, it's only going to gain steam, at least from our perspective on inflation and how that impacts different businesses. So thanks again for joining us.
Thank you, Kirk. Appreciate the time.
I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today. All right. Well, that was a great interview with Carter. Really appreciate him coming on the show. Known Carter for a number of years, and he's a wealth of information. And so now we're getting into the panel portion of the show here. So this week we have our very own Barb Friedberg. Hey, Barb.
Hello, happy to be here.
Great to have you once again. And we also have our very own Megan Gorman. Hey, Megan.
Hi, Kirk. How are you?
Doing great. Doing great. And lastly, but certainly not least, we have Doug Hagren. Hey, Doug.
Hey, good morning, Kirk. How you doing today?
Doing great. All right, so let's just dive right in. So, Barb, what were some of your takeaways from the interview?
Farmland is one of those asset classes that is not in the mainstream. We think of regular asset classes like stocks, bonds, cash. And farmland is what's considered an alternative asset class. So what you have to decide as a listener is this something you want to get into or not? And I will say it's got a lot going for it. According to the AGD Consulting, farmland has appreciated 3.5% annually over the last 30 years. And that's not the income, that's just the land appreciation. So if you're interested in this asset class, you want to learn more, there are a lot of really viable ways to invest. And as we all know, everyone has to eat. And as the population grows, so will the demand for food and farmland.
Great. So, Megan, what were some of your thoughts?
Yeah, first of all, I thought the interview was really interesting because I do run into farmland quite a bit, and it's much more in the private investing world. And I think one of the things that investors have to think about in challenging markets is how well diversified they are. And so farmland has long since been an area in high net worth in the private investment space where people have had access to this type of investing. And farmland is appealing and investing is appealing for a couple of different reasons, right? Some of it is it's rental income, right? They have great income in there. They give great diversification. And farming REITs or land associated farming, typically it has done well over the past 30 years. I think returns average, and they talked about it in the interview, between 10 and 12% on average over that time period. I think it's one of those things, however, that when you're putting in a portfolio, you want to think about it strategically, right? So when I'm building out a REIT allocation for a client, both within the private markets and the public markets, I want to make sure I'm not overexposed to any one sector. And so farmland is one of those slivers we want to have exposure to, but we don't want it to be your entire REIT portfolio. And that's because there are some risks with farmland. Think about it, natural disasters. I'm sitting here in California today, in San Francisco where it's over 80 degrees, which doesn't sound like a lot, but in San Francisco, it's hot. Crop prices can be challenging. Farmer tenants can have issues. So those are the reasons why we don't want to be overexposed to this asset class. But if you have a nice 3 to 5% exposure to REITs, and of that exposure, you have a sliver to farmland REITs, I think that's great diversification in the overall portfolio.
No, I appreciate that perspective, Megan, and I think we'll touch on the risks a little bit later because I think that's a great point. And Doug, what about you? What are some of your thoughts from the interview?
Well, instead of getting into some of the points, I've got some great statistics, but I'm going to address it from the thing that I really picked up from Carter is the lack of interest that Wall Street has had on this area of investing. And he didn't go there, but I'll say it's kind of interesting how that correlates very much with some of the political lines of our nation. I am the one of this panel that is sitting here right in the heart of farmland. I grew up in Ohio. The town I grew up in, Columbus, Ohio, was affectionately nicknamed Cowlumbus. And I watched that farmland get eaten up by suburbs. Now I live in Minnesota. I've got 77 acres or so down the hill from me that just went for sale for about $1.4 million. It is farmland everywhere around here. And, we talk about, like I said, the coasts versus the inner country here of the United States, and the differences between and the political focus and kind of who's getting the attention, right? And I think that's a great example of how it seems like when you get away from the coast, it's kind of that forgotten area, but yet it's a really critical area because without the production that occurs there, the rest of the country, if not the world, doesn't have food on its table. And now that we're starting to see some of these things happen around the world with climate, with drought, with political upheaval, with supply chain getting cut off, I think it's going to say, it just underwritten says how important the ability to get from the farm to the table has always been, and how important it's going to continue to be.
Yeah, no, I totally agree, Doug. I think it's a huge topic, and we can dive more into that. So let's kind of go into ways that you can invest in farmland. So, Barb, I want to start with you because I think this is an area that is challenging, as Doug just kind of mentioned. There's, there are a handful of ways that you can invest in farmland, but Wall Street is just generally uninterested, or has maybe not historically, but definitely in the last 20 years has been somewhat uninterested in farmland. So maybe you could kind of touch on some ways that people can kind of look at investing in farmland.
Today, there have been a brand new, well, not today, but I mean, over the past couple of years, there have been some launches of crowd-funded farmland opportunities that make it super easy to invest in farmland. Carter Malloy has AcreTrader. There are a handful of others. I cover them on my YouTube and my websites. And you can go in with a couple of bucks and buy a sliver of a farm. You get to decide which farms you want, or if you want to buy a fund with a bunch of different farms in. So access is much, much easier today. I'm not vetting, I'm not promoting any of these crowd-funded farming platforms. That's for you to do. And the things you want to look at when or if you choose to invest in a crowd-funded farmland platform, you want to look at the managers. Do they know what they're doing? Look behind the screen a little, read about them. Are these just some big Wall Street guys that thought, oh, I think I'll just start a farmland crowdfunding? Or do they have some real farmland background and experience? Then you always want to look at fees. How much are you paying to get into this investment? Because fees matter. Every dime that goes to fees is not going into your investment to grow and compound. And finally, you want to look at liquidity. How long are you willing to tie your money up for? Can you get it right out like in the stock market? Unlikely. I'm going to turn it over to Doug now, though, because I know he's looked into some other ways to capture farmland returns aside from the crowdfunding.
Hey, thanks, Barb. Yeah, so there's actually quite a few ways that you can get into this directly. Well, I mean, into this by various means, not always directly. So, of course, direct purchase. That is absolutely one of the ways you can go out and you can purchase. And I just want to kind of throw some stats. According to the USDA right now, the ownership of land around the country, there's about 61% of all the farmland is owned by farmer rancher, okay, renting the rest of what they have from third parties that they use. There's some other operators out there that own 8%, and the investor side of things, which includes retired farmers, have about 31% of the remaining land. 21% is non-operating individuals or partnerships. 10% is in corporations, trusts, or other owners. Okay. So investment is still a relatively small portion of the farmland that is out there. And we are starting to see, as culture is changing, we're starting to see a massive turnover of the focus that individuals have in where they want to put their time and efforts. And so what that means for a lot of those owner-operated farmlands, we're starting to see, just like the farm down the hill, we're starting to see those farmlands come for sale. And I know someone who has probably close to like 300 to 500 acres in Western Wisconsin. And he's still farming it. And his son technically has taken it over, but his son lives in the cities, wants nothing to do with farming. So we're starting to see generationally, you're going to see less of the next generation wanting to potentially get involved with actually putting their hands into the soil and or dealing with a lot of what it takes to own and operate this land, which could bring a lot more land available for purchase in various ways. So not only is there direct purchase, there's also specialty REITs. There's two main ones out there, Farmland Partners. They have a ticker symbol FPI, and Gladstone Land Corp has a ticker symbol Land. FP, Farmland Partners, is the largest publicly traded REIT. It has about 1.1 billion in assets. They own, as of 2019, 158,000 acres in 17 states. They're very diversified. They've got row crops that he talked about, like corn, soybean, rice, and that's about 57% of their portfolio. And on the permanent side, almonds, avocados, wine, grapes, non-tree fruit, veggies, et cetera, about 42%. Now, Gladstone, much more concentrated. They've got about 87,000 acres, mainly food crops like fruits, veggies, and nuts. And you could get those through a brokerage account. Again, we're not endorsing anything, but these are some ways for anybody to get access. Then you can get into non-traded REITs like Iroquois Valley Farmland REIT was out there. I don't know if it's open currently. I didn't look, but there's 10,000 minimum to get in with a 5-year minimum hold. So Barb talked about, if you're going to put money into something, especially if you're going to buy it directly, this is a long-term hold, but even a non-traded REIT, as we've talked about before, would be like that. And then, of course, we're talking about the crowdfunding sources. So not only is there AcreTrader, but you've got some others, Farm Funder, Farm Together, Farmland, LP, Harvest Return, Steward. There's quite a few out there. But these you can get in for somewhere between $3,000 to $10,000 an acre. But in many cases, you have to be an accredited investor. So you're going to have a fairly sizable amount of assets or income in order to be eligible to be able to participate in these. But again, unlike some of the things that we've talked about that really have very difficult barriers of entry, there isn't a ton of options out there, but there's definitely a selection of ways to get into it, regardless of your financial means.
Yeah, those are great stats, Doug. I appreciate you kind of sharing those. So, Megan, I know you work with some wealthy individuals, and I know it seems to be this trend. Jim Rogers wrote a book called Hot Commodities, maybe about a decade or two ago, where he's talking about farmers and landowners are going to be driving around in Lambos. That farming was so important. And of course, the next decade or two, pretty much commodities were as low as they've been as far as I can remember. But then you have people like Bill Gates who were buying with the second or third largest landowner in the U.S. So what do you when you're working with your clients, Megan, how do you kind of go about applying farmland to a portfolio when it's not as easy to access as probably a lot of other investments that you might see?
Yeah, I mean, this all comes down to due diligence, right? And, in the high net worth, ultra high net worth space, it's building relationships with the firms who access these different asset classes, and then doing the work in understanding how they do their due diligence to invest. And does this feel appropriate for a client portfolio? So, over time, you see things all the time for different things in investing, and it's really just doing the due diligence, which sounds boring, but that's it. I typically do not have clients do 100% farming private investment. We look for more diversified for the risks involved. But again, you see these types of trends pass through all the time, from wine to water rights to wind farms. All of those things have trends, and they appear in private investing.
Okay, cool. So one thing you mentioned earlier, Megan, was risk, and I want to kind of volley this back to you before I send it to the rest of the team here. But when you talk about risks, you mentioned natural disasters. I mean, certainly water rights is a huge one that people are arguing about in California and in the West Coast, which is such a problem.
Mhm.
But, I assume there's ways to mitigate some of those risks, right? Because farmers have been around for thousands of years, and I imagine there's ways they can mitigate that. So, how do you kind of look at risk when you're allocating farmland?
Yeah, you're looking at the underlying manager and how they're investing and what they're doing to mitigate risk. So if it's an investment where someone's making loans to farmers, are these loans fixed? Are they floating rate? If they are leases, right? Are they triple net? Are they going to, have increases as inflation goes up? So you're looking for those little pockets of protection to mitigate the risk that's inside the investment. And those are the questions you should ask. I think anytime anyone is thinking of investing, before they start looking at the materials, they should come up with the questions that they want to get answered. And when you get to those questions on risk, it's what are you doing to mitigate this if things go south? And those are the questions I would ask in terms of REITs. In case of a natural disaster, how much am I diversified? Am I concentrated in a single area, right? Am I concentrated in Minnesota or Iowa? Or am I well diversified across the US or globally? What happens in a market if crop prices fall? What happens with disputes with farmers and tenants? These are the questions you want the managers to be asking as they deploy funds, before they deploy funds.
Okay, great. So Barb, so back to you as a former portfolio manager, how would you look at kind of the risk to reward trade-off when it comes to farming with a portfolio?
The problem with farming and every other asset class is you don't know the future. So one of the biggest risks in investing is you will select one investment and then it will have a terrible period of returns going forward, because as we all know, investing is cyclical and some assets do well in certain periods and others in other periods. Commodities were delivering very poor returns for a while, and now they're skyrocketing due to inflation. So the risk can be mediated through, guess what? Diversification. As Megan said earlier, you don't want a lot of your assets in one asset class. Just have a sliver if you want more diversification. But I'd also like to throw out for you generalist investors, you don't have to own farmland. You don't have to own any alternative asset classes. You can be well diversified without it. But there are many of us in here who say, well, it's got some potential. It's got a long history of land appreciation and cash flow, and I think I want to allocate a certain amount of money towards this asset class, so choose a small amount. And additionally, if you want access to the farming industry, you can also go outside actually buying farmland and go to agribusiness. Think of the John Deeres and all of the services, the fertilizer companies that service the farmland industry. And you will have indirect exposure to that asset class as well.
Great. Appreciate that, Barb. And so Doug, as we kind of get close to wrapping it up here, final thoughts from you, and where can people find more about you?
Well, yeah. So final thoughts for me, kind of looking at a couple of things another thing that I noticed kind of when we talked about returns, over the last 50 years, going a little bit further, there's been about a 6.1% value increase per year. There's only been 5 down years in the entire 50 years in this asset class. But what I found was really interesting is that since 1991, it has produced positive returns every year, averaging 11.5% per year, and it's outperformed all other asset classes except the Dow Jones REIT index during that time. Now,
hey, I want to interrupt you though, Doug, because those statistics sound great, but how does an individual investor access those marketplace returns? Because as we all know, we can buy an S&P 500 index fund and we can get the returns of the market.
Yep.
Easy, cheap, buy and sell in and out. I'm not sure that you can say an individual investor has a way to dive in and mirror those returns. What do you think?
Well, again, I mentioned that some of the ways the individual investor can access this is through, some of the traded REITs that are out there, and some of the statistics come from that. However, where I was kind of going with this is that, as we all know, history does not represent what the future can hold. And what I took away from this is that if the only other asset class out there that was comparable during that time period was the Dow Jones REIT index, interesting that farmland is also land. REIT is also land, real estate. And so it struck me as interesting that the two best performers asset classes during that period of time were also correlated with something that we've known to be true, is that low interest rates and free access to money that's been out there in order to be able to buy these things up. So I would say that even though that has been a very strong performer over that period of time, if we start to look at some of the changing dynamics, the paradigm shift that we've talked about, and we start to look at access to capital being much more difficult, it's going to be harder to buy real estate in general, including farmland, and that could have some impact on values. Now, we could also temper that out as, against a broad real estate index. And when you start to look at farmland in general, and you start to look at the need for food, how many, as I mentioned before in Columbus, how much farmland was turned into suburbs over the last couple of years. We've been through cycles before where the farming market has tanked, and all of a sudden, there have been areas that have dried up, and then all of a sudden farming gets hot again, and people start going and trying to farm land that is historically not very easy to farm. Right. And that's, again, is that the sign of a bubble? I don't know, but they're going to go through cycles with farmland. And of course, some of the things that we might be seeing as headwinds against real estate might be tempered by some of the things that we're seeing geopolitically around the world with regards to rising population and demand for food. So this is going to be an interesting one to watch. And no, I do not necessarily think that you can look at those past returns as any clear prediction of what's going to come in the near future. But again, as part of a diversified portfolio, I think there are some very strong reasons to consider it as a piece of your pie, because I think there's a lot of opportunity out there in this area.
Great. I appreciate that, Doug. Where can people find more about you?
Appreciate that, Kirk. You can find more about me at procollegeplanners.com. This is the time of year FAFSA needs to be filed sometime around October 1st or as soon as you can thereafter for anybody that has a senior this year who's going to be going to college in 2023. There's a myth out there that if you make too much money, you can't get any aid for college. That's only one way that you can get aid for college. 56% of is the average discount for college out there. You got to know where to get it. Most people don't find out. Learn more at procollegeplanners.com. If you have someone in high school here between freshman year and senior year, this is the time to start learning about this, because the game is rigged against you, but you can even that playing field. Check us out, procollegeplanners.com.
Thanks a lot for coming on, Doug.
Thanks, Kirk.
Megan, what about you? Final thoughts from you, and where can people find more about you?
Yeah, as I said before, I think it's an interesting asset class. It's interesting to invest in it, but it will be a sliver of your real estate portion of your REIT, a sliver of your REIT portion of your portfolio. And don't hesitate, if you're curious, if you have any of this exposure today, to go on to Morningstar and do a deeper dive into what your REIT holdings are. And then if you're looking at it in the private investing space, it's always about due diligence. That's the key component. So I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Thanks so much, Kirk.
Thanks for coming on, Megan. And last but certainly not least, Barb, final thoughts.
Well, the global population is expected to reach 9.7 billion people by 2050. And if that occurs, we're going to need a 60% increase in food production. So take those stats and consider maybe farmland will be a place to be in order to take advantage of those growing needs to feed more mouths. I'm Barbara Friedberg. I just dropped an article and a video on my YouTube channel about where you can get higher cash safe yields, many of those protected by the U.S. government. So check it out at Barbara Friedberg Personal Finance and on my YouTube channel. See you next time.
Great. Thanks for coming on, Barb. And yeah, just some final thoughts for me. I mean, personally, I love farmland. I think it's a great asset. I think it's totally underappreciated and underowned in most portfolios, and rightfully so for the last 20 years because it has not performed as well as other assets. However, it is one of those assets that's been around for hundreds of years and will be around as long as we have a country, because people need to eat. And we just, not every country has this. Not every country has a, the type of conditions that allude to good farming. And we do. We happen to have that here. We happen to be very fortunate geographically. But as Carter said, 90% are owned by families, 40% is rented out. So I thought those are really interesting stats, plus some of the stats that Doug provided. I think, what's interesting to me is I heard a stat back in the early 2000s because people were looking for non-correlated assets, and timberland came up, which I thought was a great idea. It had close to 0% correlation to the S&P 500. And I thought, what a great asset. And then I realized there's really no easy way to get it. Now you look at an endowment like Harvard, which had a portfolio manager which was putting a ton of money into timberland and was making something like 37% a year, something crazy. Timberland is technically farmland, farming trees. Anyway, there's a big back and forth. You can read it. It's in the news. It was pretty interesting, back and forth about that. But that being said, farmland is an asset class that you should consider for your portfolio for many reasons. One of which is because it's underappreciated and underowned. And if you're looking for non-correlated assets, this might be a good one for your portfolio. So highly suggest you look into it. As you know, in the show, we've been talking about farmland a lot. I think given what's going on in the world and our economy, I think it's a great asset for many reasons. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.